204 billion naira. That's how much profit Oando reported for the 2025 financial year. At first glance, it sounds like the story every investor wants to hear. The company has now reported positive earnings for 3 consecutive years. Its shares trade on what looks like an incredibly low price-to-earnings ratio. On paper, Oando appears to be one of the cheapest stocks on the Nigerian Exchange. But here's the mystery. How can a company that just reported over 200 billion naira in profit still have negative shareholders' equity? Why are more than 1 trillion naira of its borrowings either in payment default or in breach of loan conditions? And why do the strongest parts of the business tell a completely different story from the headline profit? That's exactly what we're going to uncover. Because a great investment isn't simply a company that reports a big profit. It's one that creates lasting value for its shareholders.
Welcome back to Behind the Numbers TV, the channel that breaks down financial statements in plain English. No finance degree required.
Let's begin with the first question every investor should ask. Is the business actually improving? When most people hear the name Oando, they think of an oil company. That's true, but only partly. Oando is really a group of businesses. It explores for oil and gas, produces energy, and trades crude oil across international markets. Together, those activities generated more than 3 trillion naira in revenue last year. So, on the surface, this is still a very large business. But size alone doesn't tell us whether the business is becoming stronger. For that, we need to look beneath the headline numbers. The first thing that stands out is revenue. Last year, Oando generated just over 3.18 trillion naira in sales, a fall of more than 22% from the previous year. For most companies, falling sales are an early warning sign. Management's own disclosures help explain why. The company produced only about 57% of the oil and gas volumes it originally planned for the year. If you produce less, you generally have less to sell. But revenue is only part of the picture. A more important question is whether the company made more money from the business it actually operates. To answer that, we need to look at operating profit. Think of operating profit as the earnings generated by the company's day-to-day business, before unusual accounting gains or financing decisions come into play. It's one of the clearest ways to judge whether the engine of the business is getting stronger. For Oando, the answer isn't encouraging. Operating profit fell from around 570 billion naira to 241 billion naira. That's a decline of almost 58%. The weakness becomes even clearer when we look at gross profit. In the previous year, Oando generated a healthy gross profit. This year, that turned into a gross loss. In simple terms, the company's core operations became significantly less profitable. Revenue fell. Production missed expectations. Gross profitability deteriorated. Operating profit declined sharply. None of that sounds like a business enjoying a strong recovery. And yet, Oando still reported more than 200 billion naira in profit after tax. If the business itself became weaker, where did all that profit come from? Answering this will tell us whether Oando's recovery is genuinely being driven by stronger operations or something else. At this point, we've uncovered our first clue. The operating business became weaker. Sales declined, production fell short of target, and operating profit was cut almost in half. So how did Oando still report more than 200 billion naira in profit? The answer lies in something every investor should understand. Not all profits are created equal. Two companies can report exactly the same profit, one earned by selling more, serving more customers, and running a better business, the other arrived at through accounting adjustments that may never happen again. Both profits are real from an accounting perspective, but only one is likely to be repeated. That's why experienced investors don't stop at the headline profit. They ask where the profit actually came from. And for Oando, that's where the picture changes dramatically. One line in the accounts added more than 441 billion naira to earnings. It wasn't because Oando suddenly sold more oil, production surged, or because customers paid significantly more. Instead, it came from the reversal of an earlier impairment on financial assets. Here's a simple way to think about it. Imagine you believed someone who owed you money might never repay it. To be cautious, you recorded it as a loss. Somehow, you found out you'll recover much more of that money than you expected. Accounting allows you to reverse part of that earlier loss. Your reported profit increases. But no new customer appeared. No additional barrel of oil was produced. No extra cash necessarily entered the business. Compared with last year, this single accounting adjustment improved reported earnings by more than 500 billion naira. There was another boost as well. Instead of recording a tax expense, as it did the previous year, Oando reported a significant tax credit. Together, those two items largely explain why the bottom line profit looked far stronger than the underlying business. Here's a useful thought experiment. Imagine we remove just the impairment reversal while leaving everything else unchanged. Reported profit before tax was about 136 billion naira. Without that reversal, the business would instead have reported a loss of roughly 306 billion naira. To be clear, this isn't an official restatement of Oando's accounts. It's simply a way of asking how much of this year's profit depended on unusual items rather than the core business. The answer is quite a lot. Does that mean the entire profit should be dismissed? No. Accounting adjustments are legitimate when they're supported by the underlying facts, and the profit is real in an accounting sense. But it also means investors should be careful about assuming this year's earnings represent Oando's normal earning power. Fortunately, we have another way to test that conclusion: cash. An old investment saying is this: profit is an opinion, cash is real. A company can report impressive profits for many reasons, but it's much harder to fake cash flowing into the business. This year, Oando did produce positive operating cash flow, but the improvement isn't nearly as strong as the headline profit suggests. For every 100 naira of reported profit, less than 16 naira actually showed up as operating cash during the year, suggesting that much of the reported profit hadn't yet translated into cash that management could freely use. The picture becomes even more cautious after accounting for capital expenditure. Once Oando invested in maintaining and developing its business, free cash flow remained negative, meaning the business still consumed more cash than it ultimately generated. Even so, there is one encouraging development worth recognizing. At the parent company level, operating cash flow turned positive after being deeply negative the previous year. Unlike the impairment reversal, that improvement reflects genuine cash moving through the business. So the evidence points in two directions at once. The cash flow tells us the business isn't simply creating profits on paper. There has been real financial improvement. But the earnings analysis also tells us that this year's headline profit paints a more optimistic picture than the underlying operations justify. At this point in our investigation, we see that the business hasn't fully recovered. Some of the improvement is genuine, some came from accounting adjustments. But investors don't own accounting entries, they own shares. So did this year's recovery actually create value for shareholders? The earnings per share, or EPS, answers that. Think of the company's total profit as a pie. EPS tells you how large your slice is for every share you own, and share prices tend to follow it over the long run since it's one of the clearest measures of how much profit belongs to shareholders. On the surface, Oando's EPS tells an encouraging story. EPS increased from 18 naira in FY2024 to 23 naira per share this year. You might conclude that shareholders are becoming much wealthier, but a larger slice of pie doesn't always mean the pie itself became much bigger. Sometimes there are simply fewer people sharing it. That's exactly what happened here. During the year, Oando's weighted average number of shares fell by roughly 30%. When there are fewer shares dividing the company's profits, earnings per share automatically increase, even if the underlying business hasn't improved by the same amount. In other words, part of this year's EPS growth came from mathematics rather than stronger business performance. Combine that with the accounting gains discussed earlier, and we see the EPS improvement is real, but it probably overstates how much the underlying business has actually improved. Net asset value, or NAV, tells a very different story. It is what is left if a company sold everything it owned and used the money to pay every debt it owes. Whatever is left belongs to shareholders, known as shareholders' equity. For 5 consecutive years, Oando's shareholders' equity has remained negative. That means the company's liabilities still exceed its assets, a sign the balance sheet remains under significant pressure, despite this year's reported profit.
Income investors face another disappointment. Oando has now gone 5 straight years without paying a dividend. That's not automatically a red flag. Plenty of growing companies reinvest everything back into the business. But Oando doesn't fit that pattern. Its equity has been negative since at least 2021, well before its 2024 acquisition, so this was never a growth over payouts trade-off. The dividend absence reflects a balance sheet under real strain, one that the acquisition's financing has arguably deepened rather than explained. So where does that leave shareholders? While this year's results are a clear improvement over past losses, the turnaround hasn't translated into strong shareholder value. Book value remains deeply negative, no dividends have been paid, and part of the EPS growth came from changes in the share count rather than stronger operations. Shareholders benefited from improved earnings, but they still own a business with fragile financial foundations. Which leads us to perhaps the most important question in this investigation. What did management actually do with this stronger financial position? A profit doesn't automatically mean management has done a good job. The real question is whether that profit was used to build a stronger business. Oando's management deserves credit for navigating an exceptionally difficult period. Operations continued, the group remained profitable, and operating cash flow improved. But investing is about outcomes, and the balance sheet remains under significant pressure. The company carried about 2.7 trillion naira in borrowings during the year. More than 1.1 trillion naira of those borrowings are either already in payment default or in breach of the financial conditions agreed with lenders. Operating earnings also weren't enough to comfortably cover interest costs. Perhaps the biggest clue about Oando's financial position comes from the going concern disclosures. The company explains that its plans rely partly on continued support from its major shareholder and directors, including personal guarantees behind parts of its financing arrangements. That support demonstrates commitment, but it also suggests the recovery is not yet complete. A financially strong business should be able to rely primarily on its own cash flow and balance sheet. So, how should we judge management? They haven't failed, but neither have they completed the turnaround. Debt remains a major challenge, and much of management's focus will likely stay on repairing the balance sheet rather than creating new shareholder value. Given everything we've uncovered, does the current share price still make Oando an attractive investment? As at 8 June 2026, Oando traded at 40.04 naira per share. Against earnings per share of 23 naira, investors are paying a price-to-earnings ratio of just 1.74 times. On the surface, that's remarkably cheap. But valuation only works if the earnings you're valuing are sustainable. There are 3 additional risks worth keeping in mind. First, 4 customers account for more than 61% of the group's revenue, meaning the loss of even one major customer could materially affect future sales. Second, around 80% of the group's assets are located in Nigeria, with most of the remainder sitting inside a single offshore trading subsidiary. Investors are making a concentrated bet on one operating environment, rather than a geographically diversified energy business. Third, the group is involved in pending litigation totaling roughly 1.4 trillion naira. Management believes these matters will not result in material losses, and no provision has been recognized. That may ultimately prove correct, but when potential claims are several times larger than the company's market value, they deserve careful monitoring. One genuine strength does stand out. The exploration and production business generates virtually all of Oando's operating profit, while the trading business produces enormous revenue but comparatively little profit. If this turnaround is going to succeed, that's where it will be won. Now, the verdict. For new investors, watch. Oando isn't priced like a healthy business. It's priced like one the market still needs convincing about. The turnaround appears genuine, but it's still incomplete. Until production improves, cash generation becomes consistently stronger, and the balance sheet shows sustained repair, I believe this is a company to watch rather than buy.
For existing shareholders, hold. If you already own Oando, I don't think this report alone justifies abandoning the investment thesis. The business has taken meaningful steps forward, but management still has significant work to do. Future results will determine whether this develops into a successful turnaround or simply another temporary improvement. This analysis is for educational purposes only. It is not financial advice. Always carry out your own research or consult a licensed financial advisor before making investment decisions. If analyses like this help you become a more informed investor, consider subscribing to Behind the Numbers TV. So, is this a buy, hold, or sell for you? Until next time, thanks for watching.